Ruth, I have to tell you something I have never told anyone publicly. I sold everything in March of 2020. Everything. My index funds, my retirement account, all of it. The headlines were screaming pandemic, global shutdown, worst crash since the Great Depression. And I panicked. I went to cash. And then I watched from the sidelines as the market recovered without me.
And how much did that decision cost you?
I did the math last year. If I had done nothing, absolutely nothing, just left my money alone, I would have about $70,000 more than I have today. $70,000. That is what reading the news cost me.
And you are not alone. Fidelity research shows that missing just the 10 best days in the market over a 20-year period cuts your returns by more than 50%. Not the 10 best years. The 10 best days. And here is the cruel part. Those best days almost always happen right after the worst days. Right after the headlines are the scariest. Right after you sell.
50% of my returns gone because of 10 days. That is insane. And those days happen right when everything feels the worst?
Right when everything feels the worst. That is the trap. The news makes you feel like you need to act. But acting on fear is almost always the most expensive decision you will ever make. And today, we are going to show you exactly why, with real data, real headlines, and a framework that will save you from yourself.
Before we get into it, be honest in the comments. How many times do you check your portfolio in a day? Drop your number. No judgment. I used to check mine 8 times a day. 8. If this kind of calm, evidence-based thinking helps you make better decisions with your money, hit that like button and subscribe. We genuinely read every comment.
All right. Let us start with something most people never think about. The media's incentive structure. Because once you understand why the news sounds the way it does, you will never react to it the same way again.
Okay, what do you mean by incentive structure?
Financial media companies make money from advertising. Advertisers pay based on clicks and views. So every editor, every producer, every headline writer is asking one question. What will make people click? And the answer, backed by decades of research, is fear. Daniel Kahneman showed that humans feel losses about 2.5 times more intensely than equivalent gains. So a headline that says, "Market could crash tomorrow," gets 5 times more clicks than "Market continues steady growth." Fear is the product. Your attention is what they sell.
So they are literally incentivized to scare me. That is their business model.
That is their business model. And here is the data that proves it. Between 2014 and 2024, the word crash appeared in major financial headlines over 600 times. 600 crash headlines in 10 years. You know how many actual crashes happened in that period? 2. The COVID crash in 2020, and the bear market in 2022. 600 warnings. 2 actual events. That is a false alarm rate of over 99%.
Wait, 600 crash headlines and only 2 actual crashes. So 99% of the time the scary headline was just noise?
Just noise. Expensive noise if you acted on it. And this brings us to the real cost of selling on news. It is not just that you sell low. It is that you miss the recovery. J.P. Morgan's research shows that 6 of the 10 best days happened within 2 weeks of the 10 worst days. Think about what that means. The biggest gains happen right after the biggest drops. If you sold during the drop, you were not there for the bounce.
6 of the 10 best days within 2 weeks of the worst days. So the recovery happens so fast that if you blink, if you hesitate, if you are sitting in cash waiting for things to calm down, you miss it.
You miss it. And let me put real numbers on this. If you invested $10,000 in the S&P 500 in 2003 and stayed invested for 20 years, you would have about $64,000. If you missed just the 10 best days, you would have about $29,000. Miss the 20 best days. About 17,000. Same starting investment? Same time period. The only difference is whether you were in the market on a handful of specific days.
64,000 versus 29,000. Cut in half, because of 10 days out of 20 years. That is roughly 5,000 trading days, and missing 10 of them costs you half your wealth.
Now let me show you something that will change how you read headlines forever. I want to play a game I call the headline test. I am going to read you 5 real headlines from the past. And I want you to tell me honestly, would this headline have made you sell?
All right, hit me.
Headline 1, March 2020. Global pandemic shuts down world economy. Millions unemployed. Markets in freefall. The S&P 500 had just dropped 34% in 23 trading days. The fastest drop in history.
I mean, I literally did sell on that one, so yes.
And what happened next? The S&P 500 recovered its entire loss in just 5 months. By August of 2020, it was back to its pre-crash high. 5 months. And within 18 months, it was up over 40% from the bottom. The people who sold missed one of the fastest recoveries in market history.
5 months. I sat in cash for almost a year before I started buying back in. I missed the entire recovery.
Headline 2. December 2018. Trade war escalates. Worst December since the Great Depression. Markets plunge on tariff fears. The S&P dropped almost 20% in 3 months.
Tariff fears. That sounds familiar. Would I have sold? Probably not everything, but I would have been tempted to reduce my position.
The S&P 500 gained over 31% in 2019. It was one of the best years of the decade. Right after one of the scariest Decembers in history.
31% the very next year. Wow.
Headline 3. October 2022. Inflation at 40-year high. Fed raises rates aggressively. Bear market deepens. Recession imminent. The market was down over 25% from its peak.
I remember that one. Everyone was saying recession is guaranteed. It felt inevitable.
The recession never came. The S&P 500 gained 26% in 2023 and another 25% in 2024. Back-to-back years of over 25% returns. Right after everyone was certain a recession was coming.
Okay, I am seeing the pattern. Scary headline, everyone panics, and then the market goes up. Every single time?
Not every single time. Sometimes the market does go down further. Sometimes it takes longer to recover. The 2000 dot-com crash took about 5 years to recover. The 2008 financial crisis took about 4 years. But here is the key insight. Even in those worst-case scenarios, the people who stayed invested and kept contributing came out ahead of the people who sold and tried to time their way back in. Because timing the exit is only half the problem. You also have to time the re-entry. And almost nobody gets both right.
That is the part nobody talks about. Even if you sell at the right time, you still have to figure out when to buy back in. And that second decision is almost impossible.
It is almost impossible. Because what does calm down even look like? The market does not ring a bell and say, okay, it is safe to come back now. By the time things feel safe, the recovery has already happened. That is why I created a framework I call the 48-hour rule. And it is the single most important behavioral tool I can give you.
The 48-hour rule. Tell me.
The rule is simple. Never make an investment decision within 48 hours of a scary headline. Not 48 minutes. Not 48 seconds. 48 hours. When you see a headline that makes you want to sell, you write down what you want to do and why. Then you put it in a drawer. Literally or figuratively. After 48 hours, you read what you wrote. And I promise you, 90% of the time you will feel embarrassed that you almost acted on it.
Write it down, wait 48 hours, then read it again. That is so simple, but I bet it works because the emotional intensity fades in that time.
Exactly. Your amygdala, the fear center of your brain, fires immediately when you see a threat. But your prefrontal cortex, the rational part, needs time to catch up. 48 hours gives your rational brain time to override your fear brain. It is not about ignoring your emotions. It is about giving your better judgment time to show up.
Okay, so we have the 48-hour rule for when scary headlines hit. But what about the rest of the time? What should I actually be doing with my investments if I am not reacting to news?
3 things. And they are boring. Wonderfully, profitably boring. First, automate your contributions so the decision is already made before the headline hits. Set up automatic transfers to your investment account every paycheck. When the market drops and the headlines scream, your money goes in anyway. You do not have to decide. You do not have to be brave. The system does it for you. Dollar cost averaging on autopilot.
Automate so I never have to make the decision in the moment. I love that. What is number 2?
Second, rebalance on a schedule, not on a feeling. Pick a date. Once a quarter or twice a year. On that date, and only that date, you look at your allocation and rebalance if needed. Not because the market dropped, not because a headline scared you. Because it is Tuesday in April, and that is your rebalancing day. The schedule removes emotion from the equation.
If this is helping you think about money differently, hit that like button. And subscribe if you have not already. We genuinely read every comment, so tell us what you think. All right, let us keep going. What is number 3?
Third, and this is the hardest one, check your portfolio quarterly, not daily. Every time you check your portfolio, you are giving your brain an opportunity to panic. And the more often you check, the more likely you are to see a loss. On any given day, the market is down about 46% of the time. But over any given year, it is up about 73% of the time. Over any 10-year period, it is up about 94% of the time. The more frequently you look, the more losses you see. The more losses you see, the more likely you are to do something stupid.
Hold on. The market is down 46% of individual days, but up 94% of 10-year periods. So if I check daily, I see losses almost half the time. But if I check once a decade, I almost never see a loss.
That is exactly right. And this is not just theory. Nick Maggiulli wrote about this in Just Keep Buying. The frequency of checking directly correlates with the probability of panic selling. People who check daily are significantly more likely to sell at the wrong time than people who check quarterly. You are not being lazy by not checking. You are being strategic.
Strategic ignorance. I like that framing. It is not that I do not care about my money. It is that I care enough to protect it from my own reactions.
That is a perfect way to put it. And let me give you one more piece of data that ties this all together. Delbar, which is a research firm that studies investor behavior, publishes a report every year comparing what the market returned versus what the average investor actually earned. Over the past 30 years, the average investor earned just 3.7% per year, while the S&P 500 returned 10.2% per year. That gap, 6.5% per year, is the cost of reacting to news. The cost of buying high on excitement and selling low on fear. The cost of not having a system.
3.7 versus 10.2. The average investor gave up almost 2/3 of the market's returns just by making emotional decisions. That is hundreds of thousands of dollars over a lifetime.
Hundreds of thousands. For most people, it is the difference between retiring comfortably and working an extra decade. And the fix is not being smarter about which headlines to follow. The fix is having a system that makes the headlines irrelevant.
Okay, let me bring it all together. Here are the takeaways. Number 1. Financial media is incentivized to scare you. Fear gets clicks. The word crash appeared in headlines over 600 times in 10 years. Only 2 actual crashes happened. 99% of scary headlines are noise. Number 2. Selling on news is devastatingly expensive. Missing just the 10 best days over 20 years cuts your returns by more than half. And 6 of those best days happen within 2 weeks of the worst days. If you sell on fear, you miss the recovery. Number 3. Use the 48-hour rule. Never make an investment decision within 48 hours of a scary headline. Write down what you want to do, wait, then read it again. Your rational brain needs time to catch up to your fear brain. Number 4. Build a system that makes headlines irrelevant. Automate your contributions. Rebalance on a schedule. Check your portfolio quarterly, not daily. The system protects you from yourself. And number 5. The average investor earns 3.7%, while the market returns 10.2%. That gap is the cost of reacting to news. Do not be average. Be boring. Be systematic. Be calm.
The news will always be scary. Your job is to keep investing anyway. Not because you are ignoring reality, but because you understand that the market has survived every single headline that ever terrified investors. Every war, every pandemic, every crash, every recession, and it came back higher every single time. The only people who lost permanently were the ones who sold and never came back. Build wealth with patience, not panic.
Leave a comment and tell us what topic you want us to cover next. We read every single one. And hit subscribe if you have not already. See you next time.